Earnings season is when companies open the books and tell us how the last quarter actually went, and the moment those numbers hit, stock prices can jump or dive in seconds. Today, I'm breaking down why. First, the setup. Wall Street already has expectations. Analysts publish estimates. Revenue, earnings per share, EPS, margins, guidance. By the time earnings day arrives, a lot of that is priced in. So what moves the stock isn't just the number, it's the surprise versus those expectations. Cause: a company beats earnings and revenue. Effect: the stock often pops. But not always. The market cares about the why and the what's next. If the beat came from a one-time tax benefit, or cost cuts that aren't sustainable. If management guides lower for next quarter, the stock can drop even after a beat. Flip it: cause, a miss. Effect: the stock drops. But if management raises full-year guidance, the stock can recover fast. If the miss was a short-term issue, say a delayed shipment, it can reverse. Here's the backbone of almost every move: expectations, quality of earnings, forward guidance. Expectations are the bar. Quality asks, were profits driven by real growth like higher demand? Or pricing power? Pricing power. Or by accounting adjustments? Guidance tells us the trajectory, revenue, margins, and cash flow next. Valuation is the amplifier. High multiple stocks, big growth names are priced for perfection. Small disappointments can trigger multiple compression. Value stocks with low expectations can jump on modest beats. Margins matter. If revenue grew but gross or operating margin shrank, costs or discounting may worry investors. Conversely, stable or expanding margins show pricing power and discipline, often rewarded. Look out for GAAP versus non-GAAP. Non-GAAP excludes things like stock-based comp or restructuring. If the gap is huge, investors question the quality and durability of earnings. Algos react in milliseconds to headline beats or misses. Automated flows hit tape first, then humans digest the conference call, tone, detail, Q&A. Q&A can reverse the first move. Words like softness, macro headwinds, and supply constraints can hit sentiment. Phrases like demand accelerating, pipeline strong, and share gains do the opposite. Options positioning also matters. If results land inside the implied range, hedge unwinds can mute the move, or exaggerate it when outside. After-hours liquidity can magnify swings. Next day, as more investors trade, and analysts update targets, the stock can retrace or extend. Read-through effects ripple across sectors. A chip maker cutting guidance can pressure PC makers. A retailer beating on traffic might lift peers. Before earnings, know the expectations, the implied move, and the valuation. During, focus on revenue, EPS, margins, cash flow, and guidance, the story behind the numbers. After, watch the call, read analyst notes, and track how the stock behaves into the open. Earnings reset the story, and that's what the market prices.